Today we're talking about the 3% mortgage you got in 2020 and why it is not the thing keeping you stuck in the house. Here's the belief. You bought a starter home, 2 bedrooms, maybe 3. Your rate is in the 2s or the low 3%, and now you've outgrown it. New kid, working from the dining table, whatever it is. And every single person you talk to says the same thing. You'd be crazy to give up that interest rate. So you stay in the house. I'm gonna tell you the opposite. You are not supposed to give up that rate. You're supposed to move out from underneath it and let someone else pay it. I did this myself. In November of 2023, my wife was pregnant with our first son. We bought a bigger house on a bigger lot closer to her family. We did not sell the first one. It is still a rental today, and it is still held our really low rate on it. I'm gonna run the actual arithmetic in a second so you can see whether it works for you or doesn't. I'm Har-Dev, mortgage advisor here in Clovis, California, and this is what I do all day. Let's start with what the lock-in actually is. Now, 76% of homeowners with a mortgage are sitting below a 6% interest rate right now. So 51% of them say they will not sell until rates go below 5%. 20% are waiting for 3%. So here's what the whole country did. Everybody looked at a low rate and decided it was a reason to stop moving. And the reason that happened is that a mortgage rate feels like a thing that you own. It isn't. It's a price attached to one specific house. Only has a value while that house is producing something. Sitting in it, that low rate saves you a few hundred a month against today's pricing. Renting it out, that low rate is what makes the whole property cash flow. Same rate, completely different job. Are we tracking? Good. Because this next part is the actual video. Now the numbers, rough numbers. And I mean rough. Say you bought a Clovis home in 2020 for roughly $320,000 with 20% down, rate around 3%. Your payment with taxes and insurance is roughly $1,500. Your balance today is roughly $228,000. That house is worth roughly $500,000 now. So you have roughly $272,000 in equity you cannot see and cannot touch. Here's how you touch it. Most lenders will go to roughly 80% combined of your house value. So 80% of $500,000 is $400,000. Take out the $220,000 that you still owe mortgage. That leaves roughly $170,000 available to you as a line of credit. You don't refinance, you don't touch the 3%, it just sits there. Let's say $130,000 of it. At today's HELOC pricing around 7.5%, that's roughly about $813 a month. 2 piles, watch. Pile 1 is what the starter home cost you now. $1,500 payment plus $813 on the line. That's roughly $2,313 a month going out. Pile 2 is what it brings in. Average Clovis rent right now is roughly $2,395 up to about $3,000. Call it $2,300 to be safe. It washes. The starter home now pays for itself and for the money you pulled out of it. And the $130,000 is your 20% down payment on a $650,000 move-up home. At today's 6.5 interest rates, that payment with taxes and insurance is roughly $4,075. If you had sold your house instead, you'd net roughly $237,000 after paying off the loan and covering closing costs, paying the agents. Put that down on the same $650,000 house and your payment is roughly $3,400. So keeping the house will cost you roughly $675 a month more. That's the honest number. Nobody puts that in a video. Here's the one other honest number. On that 3% loan, roughly $510 of every payment you pay goes exactly to the principal. That's not an expense. That's you paying yourself every month, funded by a renter. $675 minus $510 is roughly $165. $165 a month is what it actually costs you to own a second $500,000 house in Clovis, California. If you want to see this run out on your actual address, in your actual balance instead of my example, I put together a Clovis move-up equity report. It's free, links below, and it takes me about 10 minutes to fill it out for you. No credit pull. Now let me tell you what actually kills this. Debt to income. That's the real gate, not equity in the 2 payments. $4,075 plus $2,313 is roughly $6,388. A lender gives you credit for roughly 75% of the rent of a house. So subtract roughly $1,725, you're left with roughly $4,663. I underwrite this at a 50% ratio with conventional, so you need roughly $9,300 a month coming in, roughly roughly $112,000 income a year to make this all work. So the median household income in Clovis is about $103,000, which means for a real chunk of you watching this, it does not work yet. I'd rather tell you this in a free video than after you've paid for an appraisal. If your number isn't there, the answer is not to force it. The answer is to know the gap and when you can close it. And here's why I'm even saying any of this out loud. I spent 4 years as a Dave Ramsey disciple. No credit cards, cash only, debt is the enemy. My wife and I still run his budget every month today, 6 years in. So when I tell you to open a line of credit against your house, understand that I'm arguing against my own younger self. The reason I changed is that I ran the arithmetic and the arithmetic didn't care what I believe. A line that cash flows and credit card balance are not the same instrument. One is fed by a renter, the other is fed by you. So here's where we are. The 3% rate isn't a cage, it's the cheapest debt you will ever hold. And right now it's attached to a house you've outgrown. You have roughly $170,000 of borrowing power sitting in a wall. You can move it into a bigger house for roughly $165 a month. If your income clears roughly $112 a year, roughly. And if it doesn't clear, you now know the exact number it has to clear. That's the whole thing. Nobody sold anything, nobody gave up a rate. Grab the move up equity report below and I'll run your version. And then you get to make the decision for your own quality of life, which is really the only reason any of this matters.